Happy Friday to you both. It's good to see you. Katerina, there's been a lot of discussion about how the market, for better or worse, efficiently priced in the uncertainty regarding geopolitics, but we're still left with sort of late cycle concerns, which has been a big focus for Morgan Stanley.
Absolutely. And Carl, as someone born and raised in Ukraine, this is just unthinkable and heartbreaking situation. But as private wealth advisor, of course, I encourage our clients to focus on how the situation is going to affect their portfolios. And specifically, we need to understand that this is a geopolitical risk. It does not discriminate. We saw it in early trading hours of yesterday. It's very unpredictable, but it affects all the sectors of the market, good and bad, in a negative way. And what we need to do is teach ourselves to trade into it and see it as a great buying opportunity. We've been talking for weeks and really for months about the necessity of de-risking the portfolios, of increasing the yield, focusing on quality. And this is a perfect opportunity to make that change, to make that switch, to add the sectors that we really should be owning right now, like healthcare, like financials, industrials, the sectors with the positive real yield sensitivity and strong buying power, because that's what it will take. It's going to be a bumpy ride for sure.
That's interesting, Jeffrey. I wonder, so many years of investors conditioned to buy the dips, can they be retaught to learn how to sell the rips?
This is a year where obviously volatility, I think, is going to be higher than what we're used to. And so discipline from investors is going to be important. Look, we know that sanctions are where the potential for economic disruption from an invasion was likely to come from. And in contrast to the chaos on the ground, we have clarity on sanctions, and that means that the backdrop is unlikely to be materially disrupted, getting back to where this all began, which is a period of tightening financial conditions and elevated inflation. While we believe that inflation will come down later this year and the Fed's more likely to do 3 or 4 rate hikes than, say, 7 or 8, we still think we're in an environment where volatility is high and those tighter financial conditions will continue to weigh on those stocks with higher multiples.
Well, Jeffrey, we just heard from Steve talking a bit about the Fed, but I'm curious to get your thoughts as well. I mean, potentially higher energy costs, supply chain issues that may not get resolved as quickly, but both as a result of the current conflict. Does it change your view in terms of the Fed and what it's up against here when it comes to inflation?
It doesn't. I don't think we're going to see a lot of supply chain disruption from this. This is very different than were, say, China to invade Taiwan, which has massive supply chain issues. This is fairly limited around energy and agriculture, both of which have been excluded from the sanctions. So I think, in fact, we could see shortages turn into gluts fairly quickly as we look to the second half of this year, and that will help to bring down inflation and bring down the prospects for aggressive Fed tightening.
And Katerina, I mean, you mentioned this a bit, but give us a little more here. Do you think this is going to be quite a temporary effect on the market in terms of this current conflict?
Well, I think we have to wait and see, but I agree with Jeffrey 100% that as disturbing as these geopolitical developments are, that they really take a back seat to what we see in the market, to the fact that inflation is at the 40-year high, to the fact that we're seeing the market slow down and the earnings revisions are not really kind of keeping up with the slowdown. And we hope that eventually later this year, maybe in 4 to 6 months, we're going to see some type of normalization. But without a doubt, this is a stock picker's market. This is where investors need to look at quality, at valuations, and across the sectors, really be very conscious of what they own in their portfolios, because this is going to be a challenging market to realize good positive performance, but it is possible.
Shepard Smith here. Thanks for watching CNBC on YouTube.